Good afternoon and welcome to this fingraphs.com podcast on Dukascopy TV. Today we're going to look at our cross-asset views into late summer to fall using our fingraphs.com platform. When we came in July, we were quite positive on risk assets into the summer, and for now, we do remain in this position. First of all, we look at this mosaic of four different instruments. So first of all, the mini S&P future, the Euro-US dollar, the 10-year Treasury Note futures, as well as gold. And we have them here on a daily graph, so the perspective over the next few months, and on a hourly graph, so the perspective over the next few weeks. What we could say is that on the dailies, we're uptrending still on all these parameters. The S&P 500 is still well uptrending with some potential. A bit of intermediate exaggeration here on the euro, but we believe there's a new leg up behind it. Bit of exhaustion here on the Treasury Notes, but we also don't think the uptrend is finished here. And on gold, some correction here following a huge rally in July, but also still some potential behind it. And we can see the S&P is quite resilient at the moment, and the other three parameters are in intermediate correction. So let's have a look at them one by one. First of all, we look at the mini S&P future. We can see a very strong V-shape reacceleration here from March with the Fed intervention. New highs here on the S&P 500. What we believe is interesting is that the kind of diverging triangle that we saw here with the last leg down, we believe here in March, and our oscillators, which seem to corroborate here with a consolidation on the risk index here, which is now resuming its uptrend and not yet overbought. So looking at the picture, it does look still quite positive over the next few quarters on the S&P 500, despite the current exaggeration on our envelopes. In terms of our intermediate views, the daily graph is still uptrending with some potential here, or quite a bit of potential here on our impulsive up targets, potentially between 3,600 and up to 3,900. Our risk index here is in not really in the middle of the range, but not still pretty far from the overbought zone. So we do think there's still some leeway here on the risk index, some potential here on our targets. So we're still quite positive, at least into late Q3 on the S&P 500. So our target is pretty much mid-late September, somewhere between 3,600 and 3,700. Shorter term, we're a bit exaggerated here. We can see a bit of consolidation over the next week or so, but we believe it's only intermediate and that we should resume higher in September. Now we move to the Euro-US dollar. So first to the weekly graph, we can see that we've had 2 years of consolidation here on the Euro-US dollar. We believe it corresponds to a weakness in cyclical factors. Indeed, in early 2018, the economic surprise indexes in Europe and Asia started to top. They then topped out in the US probably towards October 2018. And we've seen since then some cyclical weakness. You could also see it, for example, in commodities or in emerging markets. And since the sell-off in March and the intervention of the Fed, you've seen a strong bounce in the euro, which we believe could be the beginning of quite a strong cyclical uptrend, which may last several quarters. So this may be indeed an important reversal. Shorter term, on the daily graph, an intermediate top here, which is seeing some correction at the moment. Indeed, our envelopes were touching each other. Our risk index was in the overbought. Usually the last 2-3 weeks, so that could be until the end of the month. And then we see a new resume uptrend situation into also similar to the S&P towards mid-late September, above 120 and possibly up to 121. Shorter term, we can see the intermediate correction here and possibly a few more days of consolidation and support between 117 and possibly 116.70. So a bit more risk here, but then probably a buy the dips opportunity. Now we move to Treasury Notes and first look at the weekly graph in 2018, and this is when Powell came out with this very far from neutral comment, and that's when yields started to fall and bonds, treasuries started to bounce. We could see then during 2019 the several rate cuts, and so the bull run in treasuries, and then the 150 basis points cut following the COVID crisis, and bonds which just exploded. Well, it is still a very strong uptrend. We believe it's not quite finished yet. It still has some potential, some time left, possibly into spring next year, we believe. And here on the risk index, well, we're quite elevated, but we're not overbought yet, so that would corroborate this still bullish stance. Some consolidation here on the daily graph. Our targets, impulsive targets, have been met, but we could still envisage impulsive 2 targets at some point. We can see here that the risk index is quite overbought, but we still believe that we're in some kind of consolidation range before a new upside breakout, possibly from September, perhaps for a growth extension in equities, and then for a more defensive shift during early mid Q4. But then we believe that uptrend eventually extends into next spring. On the hourly graph, some consolidation at the moment, possibly towards an oversold situation towards the end of the month, maybe early September at the latest. So we believe still a buy the dips opportunity on treasuries, although it is quite exhausted in terms of targets. Finally, we look at gold, which has seen a tremendous uptrend since August 2018. We can see that it's reached our impulsive targets to the upside on weekly graph. But if we do calculate our impulsive 2 targets, they lead us into 2,300, maybe 2,400. So there's still some potential here. Gold is pretty much inversely correlated with yields. So if we do expect yields to remain quite soft into the spring, we believe the uptrend on gold could continue into next spring to reach those targets. And at the moment, if you look at the risk index, although we've had a tremendous rally, it is still quite some ways below the overbought zone. So there's still some leeway to move up here. Shorter term on the daily graph, a very strong rally in July, an intermediate top, some correction at the moment. We could see the risk index was quite overbought here. Usually also the last 2-3 weeks, a very strong uptrend as we're seeing. And then from the end of the month, early September, we believe a new leg up, which may extend slightly further than the other assets we're looking at today, given the defensive nature of gold, maybe into October. Targets towards 2,100 and possibly the upper end that you don't see here, possibly towards 2,200. So maybe 2,200 early October and then 2,400 next spring. And then the hourly is in consolidation, a bit of risk here over the next few days, probably into late August, early September, but we believe that's a buy the dips opportunity that should be seized for the new rally into early Q4. Finally, we look at all 4. Which we could call risk assets, but mostly anti-dollar assets at the moment. And for now, the mini S&P future, euro dollar, treasury notes, and gold are all still uptrending and possibly, according to our analysis, into the end of Q3. Thank you very much. Have a good week and have a good trading. Bye-bye.